In personal finance, many people unknowingly operate based on financial assumptions that may seem logical on the surface but are actually misleading or inaccurate. These misconceptions can result in poor financial decisions, missed opportunities, and financial distress. Understanding these false assumptions is crucial for making smarter choices with money, from managing debt to investing and retirement planning. In this video, we will explore the top 10 common financial assumptions that are actually false and explain why they should not be relied upon for sound financial decision-making. 1. You need to be rich to start investing. One of the most common misconceptions about investing is that you need a large amount of money to get started. While it's true that some investments, such as real estate or certain stocks, require a substantial initial capital outlay, there are many ways to invest with smaller amounts. Thanks to the rise of robo-advisors, low-fee index funds, and fractional shares, it's easier than ever for beginners to start investing with small sums. In fact, many investment platforms allow you to invest as little as $5 or $10 at a time. You don't need to wait until you're wealthy to start building your investment portfolio. 2. Debt is always bad. Debt is often seen as something to be avoided at all costs, but this is not always true. While high-interest consumer debt, like credit card debt, can be financially harmful, not all debt is inherently bad. For example, taking on debt to invest in real estate or to fund a business can provide the opportunity for substantial returns, particularly when the interest rates are low. Likewise, student loans can be a necessary investment in your education and future earning potential. The key is managing debt wisely, taking on only what you can afford to pay back, and using it strategically to build wealth. 3. You can't retire until you have $1 million. Many people believe they need a 7-figure nest egg in order to retire comfortably. While it's true that a larger retirement fund provides more financial security, the amount you need to retire comfortably depends on various factors, such as your lifestyle, retirement goals, and spending habits. With careful planning, it's possible to retire on a much smaller amount by living frugally, downsizing, and having a clear budget for retirement. Additionally, your retirement savings may grow over time with compound interest, which can reduce the amount you need to save up front. 4. Renting is throwing money away. This is a common assumption among people who are trying to decide between buying and renting a home. While owning a home has long been considered a key part of building wealth, renting can be just as financially smart in many situations. Renting may be more cost-effective in certain markets, especially when property values are inflated or when the maintenance and repair costs of owning a home exceed the benefits. Renting also offers flexibility and mobility, allowing you to avoid the long-term financial commitment and market risks associated with buying a home. Renting can be the right choice depending on your personal situation and long-term goals. 5. Credit cards are always bad for your finances. Credit cards often get a bad reputation because they can lead to high-interest debt if not used carefully. However, when used responsibly, credit cards can be a valuable financial tool. They can help build your credit score, offer rewards, and provide protections like purchase insurance and fraud protection. The key is to pay off your balance in full each month to avoid interest charges and fees. If you can manage credit wisely, it can actually benefit your finances in the long run. 6. You should always pay off your mortgage early. While it's true that paying off your mortgage early can reduce interest payments and increase your financial freedom, it's not always the best strategy for everyone. For example, if your mortgage rate is low, you might benefit more from investing extra money in higher return assets, such as stocks or retirement accounts, rather than paying off the mortgage early. It's important to weigh the benefits of paying off debt versus investing for higher growth, considering your risk tolerance, financial goals, and other obligations. 7. The more you earn, the more you can spend. Many people assume that as their income rises, their spending should also increase. This assumption is a key factor in lifestyle inflation, where people spend more money on luxuries and unnecessary items as their income grows. However, just because you earn more doesn't mean you should spend more. In fact, maintaining a modest lifestyle and saving or investing the extra income can lead to greater long-term wealth. Prioritizing savings and avoiding the temptation to increase your spending can be one of the most powerful ways to build wealth. 8. Stock market is too risky for long-term investors. The stock market is often seen as a high-risk venture, especially for those who are new to investing. While it's true that stock prices can be volatile in the short term, long-term investors generally experience less risk due to the market's historical growth over time. In fact, the longer you stay invested, the more likely you are to weather the market's ups and downs and come out ahead. Stocks tend to offer higher returns than other asset classes like bonds or savings accounts over the long run. A well-diversified portfolio can further reduce risk, making stocks a valuable tool for building wealth over time. 9. You should always invest in your employer's 401k. Employer-sponsored 401k plans are often promoted as the best way to save for retirement, especially if the employer offers a matching contribution. While this is a great option for many people, it's not always the best choice in every scenario. Depending on your financial situation and goals, you may find that contributing to a Roth IRA, a traditional IRA, or investing in a taxable brokerage account offers better tax advantages or more flexibility than a 401k. Additionally, some 401k plans have high fees, which can erode your investment returns over time. It's essential to compare all options and make the best decision based on your specific needs. 10. You need to start saving for retirement early, but it's never too late. While it's true that starting to save for retirement early can have a significant impact on your long-term financial security, it's also a false assumption to think that it's too late to start saving. Even if you're in your 40s or 50s and have not started saving for retirement, you can still make substantial progress. By saving aggressively, cutting back on non-essential expenses, and investing wisely, you can make up for lost time. Compound interest is still a powerful tool, and even a smaller amount saved regularly can grow significantly over the years. It's never too late to start building your retirement savings. Personal finance is filled with assumptions, many of which can steer people in the wrong direction. Whether it's the idea that you need a large amount of money to invest, that all debt is harmful, or that buying a home is always better than renting, these false assumptions can prevent individuals from making the best financial decisions. It's essential to challenge these misconceptions, do thorough research, and adopt a more informed approach to money management. By recognizing the truth behind these common financial assumptions, you can make smarter decisions that lead to long-term financial stability and wealth.